Everyone, welcome back to my channel Achieving Alpha. And in this video, we are going to discuss about an advanced option strategy, which is the double diagonal spread. Now, I'm sure that you must have seen my previous video on some of the basic option strategies that I had uploaded, and that is sort of a prerequisite for this video. And I'm also assuming that if you're watching this video, you're already familiar with the basics of option. And this strategy has a really high probability of profit, and the weekly range that you get for Nifty is 1000 points, and that you get for Bank Nifty is 2500 points. And usually you would see that most of the times Nifty doesn't move by 1000 points in a week, and Bank Nifty doesn't move by 2500 points in a week. These events happen only in case of a black swan event. Otherwise, these are pretty range bound and stay within 1000 points or 2500 points. So without further ado, let's begin. So the double diagonal spread is a modified version of the normal iron condor. So what we are going to do is we are going to learn about some of the points about this strategy, and then we are going to go away to Opstra and just simulate and see how we can create and deploy this strategy. So as I mentioned, it's a modified version of the normal iron condor, but one of the issues with the normal iron condor is the small range or the narrow range that it has. So although it has a high probability of profit, but the range is really narrow, and iron condor is made for sideways markets. If the markets are volatile, iron condor is of no use, and especially if you look at the current scenario, the markets are really volatile. So you need a strategy that can support volatile markets, and this is the one that can help you with that. So yeah, as I mentioned, it supports volatile markets and it has a broad range, as we discussed, and we'll see in the simulator as well. And again, it has a very high probability of profit and works most of the times. So you can use this as a strategy to generate some weekly income, and this is basically a good strategy for the part-time traders or people pursuing jobs for a steadily weekly income. Or yeah, this should be a weekly income. I'm sorry, I mentioned monthly here, but this should be weekly. And yeah, this is good for people who cannot track the stock markets actively. And the strategy has a positive vega. So for those of you who are familiar with the option Greeks, a positive vega means that the strategy is going to support volatile markets, and it is obviously having a positive theta. So if the market stays where it is, you are going to eat up the premium in the form of theta decay. And this is an optimal strategy for most market conditions. As I mentioned that Nifty hardly moves 1000 points in a week, and Bank Nifty hardly moves to 2500 points in a week. That is a huge movement, and it usually doesn't happen. And yeah, your profits will increase when the volatility increases. So currently you see that volatility or India VIX or any volatility index is touching new highs because of the volatility in the markets. So yeah, I guess this is all about the theoretical points. Now let's just go to Opstra and create this strategy. So here we are at Opstra, and let me first show you quickly about iron condors, just so you get a recap of what we are trying to do here. So if I'm trying to create an iron condor, let's say for the next week, for the expiry of 7 Jan, I will short a call option 14,200 and then maybe hedge it with 14,400. And on the downside, maybe I can just short a put option of 13,800 and hedge it with 13,600. This is a normal iron condor that we all are familiar with, and you get the probability of profit to be around 50%. This is the max profit, this is the max loss, and this is the range. Now, this range is also okay, but maybe we want more because markets are really volatile right now and we don't really know what would happen. So, yeah, and also let me show you the Greek. So, you can see that this is vega negative, so this is for the sideways market, and the theta is positive, that is anyways fine, but the vega is negative, so one volatile move can give us this loss. And one more thing to note is that this maximum profit will only happen on the expiry day, and this max loss will also happen on the expiry day. So this was iron condor. Now let's try to create a double diagonal spread. Again, we are doing this for the 7th January expiry, and let's start by shorting 14,300 call option. Now, why 14,300 and why not something else? So this depends. You can choose this strike price based on technical analysis, based on option chain analysis, based on price action, and also based on India VIX and volatility. So I have a video which explains how you can select the appropriate strike price based on India VIX and volatility. So do check that out. So yeah, we are shorting one lot of 14,300 call option, and uh, we are shorting a put of 13,500 of the 7 Jan expiry, and now let's just hedge it. So the difference between iron condor and double diagonal spread is that in iron condor you hedge it with the current expiry, but now what we are going to do is we are going to hedge it with the next expiry. So for 13,500 we are going to select 13,300 and buy a put to hedge it, and for 14,300 we are going to select 14,500 call option and buy it to hedge it. And here is your strategy. So you can see the range, it's almost 1,000 point range, and look at the probability of profit, man, it's 75%. And anything, if you can get it about 60%, it works most of the times. So yeah, and look at the maximum profit. I know the maximum loss is a bit intriguing, but again, that happens when the market falls to 12,537. Could you imagine it? The markets are currently at 14,000. Such a big fall is really hard. It's not easy. And you can see that even if the market stays where it is, you get a profit of roughly around 600 rupees. But it's really hard that in 7 days the market won't show any movement at all. And if at all it moves on either side within our desired range, you can see the profits with just one lot for yourself. And again, as I mentioned, that as the volatility will increase, our profits will also increase. So let me show you. If the volatility increases by 5%, you can see that our profits are also increasing. And in case market returns back to 13,500 or it goes to 14,300, we get the maximum profit on the expiry day. We can also do this with Bank Nifty. So let me show you with Bank Nifty. So for Bank Nifty, we are going to do this for the 7th Jan expiry, and let's short 32,500 call option, and let's short 3,500 put option, and now we'll hedge it with the next expiry with let's say 30,000 put option, and on the call side maybe 33,000. Yep, this is how it is. And again, you can see we have a similar payoff graph here, and this is again a big range. This is really huge. This is more than 2,600 points, I guess. So this is great. And as usual, if I increase the IV or the implied volatility, you can see that our profits will also increase, because when IV will increase, these premiums will spike up. These premiums for the 14 Jan expiry will spike up. And the reason why this works is because if it stays within our desired range, these premiums are anyways going to be zero. But these premiums, they will not become zero. They will become zero only if they're out of the money on the 14th January of expiry. So this is why this works. And again, this has a really high range, a really great probability of profit, and a really good max profit in case Bank Nifty expires at 3,500 or 32,500. So I guess this is an amazing strategy, and this works most of the times because markets don't move this much in a week. And I think job doers or people who don't have much time to see the markets can use this to generate a weekly income for themselves in a low risk manner. I won't call it entirely risk free, but it's a low risk. And I would say that this is great. And you can also see that you don't need much capital to do this with one lot. You will need about 50,000 with one lot for both Nifty and Bank Nifty. So yeah, as I say, definitely try it out with one lot for a week, see how it works out for you, and if you're satisfied, then gradually increase the quantities. So I think that this was an amazing strategy, which you can definitely try it out. Do let me know your feedback, and do like the video if you're enjoying the content. Also subscribe the channel for more such videos. And this is one of the advanced option strategies. I have a lot more to bring in. So yeah, I guess this is it for this video. Then see you in the next one. Take care and bye bye.